your net income. The money that you actually get in the paycheck after FICA, Social Security tax, after your 401k deduction, after your insurance copayment, after any of the things that you have taken out of your check, that is your actual take-home pay. Okay. So as a general rule, you want to spend no more than about 30% of your monthly gross, of your monthly top number. We'll take it, your top number is your gross number on housing. So as a general rule, 30% is what you want to spend on housing. Now, if you're a renter, that 30% includes your utilities. And if you're an owner, it includes other home ownership costs, like your mortgage interest, property taxes, maintenance. As a general rule, 30%. Now it can fluctuate a little bit. You may be at 31 or 32, but you definitely want to keep that around the 30%. Anything 35% or higher, that means that's, remember the first class we talked about living within our means. Anything over 35%, that's not within our means. So again, 30% includes your utilities. So 30% would include your KUB. If you pay for water separately, that 30% would include that. Okay, so let's talk about some real numbers. So if you make $15 an hour, that equals about $600 a week at 40 hours. So this is full time. So you can always come back to the replay of this if you need to see how I calculated it. But I did longhand math on this. You remember how your teacher used to say, show your work? I wanted to show the work so you could see how I got to these numbers. So $15 an hour, if you make $15 an hour, that equals about $600 a week. $31,200 a year would be your annual. And these are gross numbers. So this is not your take home, this is your gross number. So you take your $31,200 a year times 30%. That means annually you want to stay around $9,360 in housing costs for the year. Then you divide that by 12, that's $780 a month in housing costs. So what does that mean? If your rent is $800, you're already over the 30%. And we haven't even added in the KUB. We haven't even added in your water costs, because some people pay that separate. So we haven't even added those in yet. So your $800 a month rent should include your utilities as well. So at $20 an hour, that's about $800 a week, $41,000 a year. 30% of that, $12,480. Divided by 12, $1,040 a month in housing costs. So if you're an owner, $1,040 a month in housing costs, that would need to equal your mortgage payment, your homeowner's insurance payment, maintenance on the house, $1,040 a month. Now you may think, well, man, all of that together does not, that's quite a bit. Absolutely. And the reason why these numbers say about 30% is because, remember, we're talking gross. We're talking your top number. That's not actually what you bring home yet. So what we bring home, we know, is much less. So $600 a week is your gross. Well, how many of us, by the time you get it, it's 462? It's 502. So 600 is not even what you see. You see probably less than 500 of that. Probably around the 420, 430, because Social Security tax is 6%. But that's a whole nother calculation. So that's why we say keep it around 30%, is because we're talking your net income plus all of the other things that you need to live, 30%. So you can plug in your own numbers in this. If you make, minimum wage, or if you make $9.50, if you make $10, if you make $8.75, this is how you calculate to know about how much should I be spending in housing payments, in rent, in mortgage, about 30%. Now, in general, now don't forget the 30% for your housing costs, for your rent, for your mortgage. Well, now experts recommend spending about 10 to 15% of your income on transportation. Transportation, including your car payment, insurance, and your gas, your fuel. So we've got 30% for rent. I'll just say rent for purposes of, we got 30% for rent. Then we have another 10 to 15% of your gross on your car payment, insurance, and fuel. Okay, so for example, if your take-home pay, after your taxes, after your Social Security taxes have been taken out, after federal income tax, after insurance, 401k, and any other deductions that you have. So this one, if your take-home pay is $4,000 per month, then you should spend about $400 to $600 on transportation. So between your car payment, the insurance for the car, and how much it takes to gas it up every month, that should stay around $400 to $600 if your take-home pay is $4,000 a month. If your take-home pay is $2,000 per month, $2,000 per month would equal about $200 to $300 in transportation costs. If you make $2,000 per month, it's $500 a week, $12.50 per hour. Now you can plug your own numbers in there, but that's how you calculate it. So $2,000 a month, that's $12.50 an hour, $500 a week. So that's high. So don't forget, you got your rent, that's 30%. You got your car, that's 10 to 15%. And you haven't even bought any groceries yet. You haven't even the cell phone and the Comcast and any of the other things. And we're already at 45% of your income going somewhere else. To the most people, where you live and what you drive are normally your two largest expenses, normally. Now, there may be some other things. Some people may have one or two things that's a little larger, but on the average, where you live and what you drive, those are going to be the largest two expenses that you have. Okay. So you want to make sure that you're writing this down. You want to make sure that you plug your numbers in based on what your income is and calculate it that way. And then once you calculate it, if you're over, then you're going to, you may need to make some decisions, because when we say living within our means, that definitely you want to, now you may be a percent or two off. Your transportation costs may be 16%, 17 instead of, the 10 to 15%. And that's okay. It may fluctuate just a little bit, but you definitely, if you make $12.50 an hour and your car payment is $500, that's high. Okay. If you make $12.50 an hour, $2,000 per month take home, and your car payment is anywhere over about the $350, $375, that's high. And that's extending. And that's why your discretionary income at the end of the month, there's not a bit, because you're paying quite a bit. So you definitely want to look at that. And even when car companies are looking at that, we do that. I do car loans, and I definitely, I make people, or I have people give their income verification, and we calculate, if we give you this loan, how much of this is it within the 10 to 15% range? We calculate that. If we do this mortgage, is that within the 30% range of your income? So underwriters and lenders, we use these same calculations to make sure that we keep you within that, because we know anything outside of that, you're stretched and you may not be able to keep that payment up. So keep that in mind. Some of this is stuff that you could calculate before you go to the car lot, before you go to the bank, before you call the mortgage lender. Some of this you could calculate and you already have an idea of where you are. So the first couple of weeks, we talked about things we want to make sure that we're doing. And I apologize if I'm moving around quite a bit. I want to make sure that we get some things in this last class. And you can come back to either of the first two classes as well and watch the replay. All of these calculations are on there. But we remember we talked about having 3 months worth of living expenses, just in case something happens and the job sends you home. Pandemic, the job sent a lot of people home and said, you know, we're on lockdown. We're not letting people in. So go home, that type of thing. And I said, well, let's, you know, you definitely want to have 1 to 3 months worth of living expenses. Well, this gives you what that looks like. So if your annual income is around $15,000 a year, that would mean you make about $1,250 a month. Your average monthly living expenses would be about $1,000. When I saw this, I thought, wow, that is nothing, hardly anything rather left at the end of the month. If you make $1,250 a month and your average living expenses are $1,000, you have barely anything left. However, then that means your 3 months worth of living expenses is $3,000. Now I'll let you know, I'll let Bishop talk to you about, you know, what your gross and net, where your 10% come off of. We're not gonna even get in. I'm gonna let the theologians.
You gonna put that on me, huh?
I'm gonna let the theologians, you know, tell you about, you know, where to put the 10% and whether that comes off your gross net, or, you know, I'm gonna let them do that. But what you do is you look at this table and see where you land. I was gonna cut the table off because it goes all the way to 250,000, and I said no, because everybody on this line not only has the potential to get to 250 if they're not already there, but you can exceed that. So when you get to $250,000 a year, LaShawn will be there, and I dare you to just, you ain't even got to unmute, but I dare you to just agree and decree that and say, hey, Prophet Shaw will be there, Minister Lisa will be there. Just put your name in there and be like, oh, I definitely am going to. LaShawn will be at the 250,000 annual income sooner rather than later. Your monthly income would be $20,000. So I want you to keep this table in mind so that you know, as you're calculating where your monthly expenses in your 3 months come from, this is what it's going to look like. And this is the goal that you're going towards, to have 3 months worth of living expenses. That way, if something happens and you can't work, or you have to go on leave or anything like that, you can go for 3 months with no income and still stay in living the way you were prior to that. Okay, so let's look at insurance for a little bit. Let's talk about insurance. So we've talked a bit about having insurance and making sure, life insurance is what I mean, not health, but having life insurance and making sure that your family is protected and that you are protected. So not only your family, but what would you do, you know, if one of your children, what would you do if a loved one passed away with no insurance? Who would pay for that? So it's not only making sure your family is protected, it is making sure you're protected. My parents continually ask us all the time to make sure that we're good, make sure that we've got some things in place, because they understand, hey, that's my daughter. If she doesn't have anything, then we're going to be responsible not only for her final expenses, but there's some debts that I've got that they would have to take care of. So we want to definitely make sure that we're taking care, our families are protected, and that we are protected. I've got some young adults, and then I've got a small 11-year-old. If something happened to mommy, I would hate to pass my debt down to my children. That would be horrible. So I want to make sure that I'm protected and that they are protected. So term versus whole life. Term insurance is something that you'll hear. Term protects you for a limited number of years.
LaShawn,
Yes, sir. Yes, sir.
before you go any further, I want to ask a quick question, because
Yes, please.
in the and I'm thinking of the answer, but I wanted to just put it out there. When you speak of you may have some debts and things that need to be taken care of on back, like if you were to pass and your children not having to take on some of that stuff, or things that they would have to take on, what are some of those things that they might have to take on if you were, God forbid, to go home and be with the Lord?
Now that's a very good question, because there are some things that companies will just write off because you are deceased. So there are some things that they would not. But think about things like your mortgage. Now, unless you are you're okay with giving the house back to the mortgage company, the mortgage they would have to take care of, or it would foreclose. Your car, if your car is not paid for and your children keep your car, they would have to pay for that, or it would be repossessed. Now, some other things like your credit card payments, no, those things get written off as a deceased client. So there are just certain things like that, certain like even your student loans, if it was yours alone and not tied to anything. But with that, and I'll let and First Lady can teach more on this as well. But with that, some of that debt, they can come back and put a lien on the house and say, hey, this has to be paid first before you sell. Even if the house is paid for, there are certain federal debts that they can put a lien on your estate, on anything that you owe. So the kids can decide not to pay certain debts, but they can come back and put, if that house is in your name, if that car is in your name, that they can then put a lien on things to make them have to pay it if they're going to keep it. That's a very good question. A lot of times we think, well, they can have it, because I used to say, I want the last check I write before I die to bounce, because I ain't leaving nothing. Yeah, I had to rethink that. That is the stupidest thing I could have ever said. As I learned better, I thought, oh my God, my kids would inherit all of that. Not only would they inherit what I have, they would inherit my debt. And there's not a pretty way around that, unless you're okay with your kids not living in your house or not having any of your estate, because debtors can come back and sue your estate for that. So that's a very good question, Elder. Thank you for that. So term.
Minister LaShawn.
Yes.
Can I add something to that?
Yes, please.
I like to say that last year when my mother passed away, she was in a nursing home. And so I'm still paying that bill that she had when she's in the nursing home. Also, she left property here. And of course, I'm still paying on that. And so I just want to share with you all that such as like a nursing home, if you have a bill left over, you will have to pay it, or they could try to take my mother's house to get that payment.
Yes, ma'am. That is very good. Thank you, sir, so much, First Lady. Thank you. That is awesome. That is very good. Yeah, I've seen people say, well, they can wait on it. No, they're not gonna wait on it. What's gonna happen is if you pass away with nothing, they will then start to attach stuff to what you have. And like First Lady said, her mother has gone on to be with the Lord, and she's still paying the nursing home where she was
And the house payment.
and the house payment.
Yes.
Because they probably, what they can do if she decides to stop paying for the nursing home is they would then put a lien on the house.
Right. Or try to sell the house and get their money.
Yep. So that is very good. So these are the things you definitely want to think about, with your families. You want to sit down and you want to make a list, and you want to make sure, hey, if something happened to me today, Elder Long, what would your children inherit? What type of debt would they inherit? And would you leave them enough to take care of that? We had a family member pass just 2 years ago. The kid's grandmother, bless her heart, she was 93 years old, had lived in the house on the west side of Chicago for about 47 years. It was completely paid off, no debt, no anything. And, bless her heart, the policy that she had was really small, and they never checked on it. She had it for a long time. It was paid for, but they never checked on how much the policy was, and it was really small. And so when she passed away 2 years ago, it wasn't enough for her final expenses. And then the other family members didn't have any reserves or anything to help. So the funeral home, because she's such an amazing woman, the funeral home knew who she was. They went ahead and took care of her expenses and then attached the lien to the paid off house. So now they can't even sell the house without taking care of the funeral home first. So you definitely, those are the things we don't always know is going to happen in the background, but you want to make sure that you have enough. If something happened to me, I want the children to have enough to not only take care of my debt, but if they want to go on a cruise around Alaska, I want them to have enough to do that. So term insurance protects you for a limited number of years. Whole life, it's lifelong protection, and you can get it. They normally mature when you reach age 100, but it can also be extended to age 121. So some clients live longer than 100. Then what happens is it extends to age 121. So those are the difference. Term protects you for a limited number of years. And when you get into that insurance policy, make sure you know what that term is. Sometimes it'll be 10 years, 20, 30 years, but it has a start date and an end date. Term insurance does. So this is a quick comparison of the differences between term versus whole life insurance. So term is temporary. It's got like I said, a start date and an end date. Whole life is long-term coverage as long as you pay. So let me do that. So as long as you pay, whole life, and a whole life, I typically, you can do monthly, you can pay annually, but then you can also pay one single premium and be done with whole life. So sometimes clients just want to pay, $100,000 just upfront for a $400,000 policy. So you can do that as well. Term life protects your family from a loss of income. It's a good idea until you've raised the kids, until the kids have gotten older or paid off the mortgage. And then sometimes clients will decrease the amount of term as that debt is being paid off. Whole life ensures that your burial costs and other final expenses are covered. Term life, lower payments to start off. Whole life does cost more, but it has some flexible payment arrangements as well. Term life premiums increase with each renewal. So it starts low. So if you're in your 20s, it starts low. And then when you reach your 40s, the premium will change. And when you get to 60, 50, 60, it'll change again. So some clients don't like that, but it does change. It starts off low, and then as you get older, it actually gets more expensive to insure you, then your premiums go up. It's no cash value. So if you stop paying, you just lose whatever that insurance is. And then term life, your benefits do transfer to your beneficiaries tax-free. So some people you want to make sure that your term, if I get a death benefit of $100,000, that I don't have to pay taxes on that. Okay. Whole life, your premiums don't rise. They actually stay the same. So don't forget, whole life, it does cost a little bit more to have it, but your premiums stay the same. 20, 30, 45, 57, 82, your premiums will stay the same. They don't rise as long as you pay them. It's a fixed payment. It does build cash value. It's very little, but it does build cash value that you can borrow against later. And then this one as well, your benefits transfer to your beneficiaries tax-free. So the pros and cons. The first one is term life. A good thing is the lower premiums when you're younger. Beneficiaries will receive larger death payouts because it's cheaper when you're younger. So some clients get more. So your beneficiaries actually get larger ones because you can afford larger ones. And then it can be converted to whole life insurance later. Some of the drawbacks of term insurance, it's temporary. Remember, I said it has a start date and an end date, so it's temporary. You must re-qualify at the end of the term. So if you're 35 and you get term insurance now, at the end of your 10 years or 20 years, whatever term you decide, you'll have to re-qualify again. Your premiums can go up every time you take out a new term because it gets more expensive to insure you. And your policy accumulates no cash value. The second table is whole life. Some of the pros, it builds cash value and your premium amount is fixed. It's a fixed amount. You don't have to wonder what it's going to change to. It's going to be the same one every month. And remember we said whole life goes until you're 100. And then if you live past 100, it can be extended till you're 121. So your premium amount until you're 100 or 121 is the same every month. Some of the drawbacks, though, it is more expensive than term life. It is more expensive and a smaller death benefit most times because it is more expensive. Some people aren't able to afford the larger death benefit. So this is some of the cost examples. I wanted to make sure again that I gave you some real numbers because sometimes people think that it is just so expensive to get life insurance and they say, well, I can't afford it. Well, let's look at some real numbers. Now, as a rule of thumb, insuring males always going to be more expensive than insuring females. They do take into account heart disease and different things. That's the number one killer of males. So, and these don't include premiums if you're a smoker. Smoker premiums are higher, but you still can get insured if you're smoke tobacco. So if you look at that top one, a term life insurance for a 50-year-old male is about $27.50 a month. A month. $30 for a whole life policy. But look at the difference. $27.50 a month for a male, 50 years old, for $250,000 policy, term life. The whole life policy, not only does it cost more at $30 a month, it is only $10,000. So remember we said one of the cons of the whole life is it's a lower death benefit. Look at the difference. That's because you're going to pay $30 every month until you're 121, but your death benefit is only $10,000. This one, if you're 50, $27.50. Now females, we look at the bottom table. For a 50-year-old female, 10-year term life, $250,000 death benefit, it is $22.47 a month. A month. I spend $22.47 when I take the kids to McDonald's. I actually spend more than that. So it's really not as much as you think. And I wanted to give some real numbers so we can definitely know it's not as much as you think. $22.47 for someone that's 50, that's not a lot. You can pay it monthly, you can pay it quarterly, you can pay it every 6 months, you can pay it every year. But these are some real numbers. So please look back at this at a certain point, just if you wanted to, and look at if you're 65, it's $109.65 a month. That's still less than our Comcast payments. That's still less than our cell phone payments. That's still less than what we use to eat out. So it's really not a lot, $109.65. So if you don't have anything right now, please take a look at these numbers. And definitely, and we're talking about 250,000. So you don't have to get 250,000. You can get 50,000. You can get 100,000 based on what you need to protect your family, what you need to pay off debt that you have, and depending on if you want to leave somebody a couple nickels to rub together, you know, that's, look at this table and you can decide where you and your family is most comfortable, where you fit. Any questions so far about our insurance? Term versus life, male versus female. For smokers, your premium is actually going to double. It'll be about double of this for people that are smokers, because they feel like, for people that are smokers, it's about double the premium, but you can still get covered. Okay, so please make sure to take a look at the term versus life, the pros and cons, and then the actual cost, the actual number of what it would cost you to insure. And if you've got a parent and they're on a fixed income and they're on Social Security or disability, and you want to make sure that there is enough, or they're not able to handle that payment. If you've got a parent that's 70, you see on the table about how much you would have to invest for a $250,000 life policy for your parent or grandparent or aunt or uncle or someone who's older. So that's sometimes you may need to take out a policy on behalf of someone else just to make sure that they're covered. Okay, so let's get into a little bit of purchasing a home. So we've talked about expenses. We've talked about 30% of a housing payment, 10 to 15% of our income should go towards your transportation or your car. We talked about living expenses. We talked about insurance. So let's talk about if you are looking to purchase a home at some point in the near future. So these are the things that a lender is going to look at when you're purchasing a home. They're going to look at your credit score. They're going to look at your debt to income ratio, meaning how much debt do you have compared to the income that you have coming in. You'll need a down payment. So they'll look at, do you have at least 3.5% as a minimum down payment? Closing costs for purchasing a house. And so the 3.5%, and we'll get into some real numbers, has to do with the amount or the selling price of the home. 3.5% of that as a minimum, 3.5%. There's not many lenders, and you'd have to be a really strong candidate to get a no down payment mortgage. So I'll just say that there are some people that still get that, but you'd have to be a really strong candidate. Otherwise, 3.5% is the minimum. Closing costs, 2 to 5%. When we say closing costs, you have to pay for title fees. There's a title company that looks up the title of the house that you're buying to make sure that you can buy it. That's what the title company on file with the county, wherever you're buying, the deed for that house has who owns it. And the title company researches that to make sure that that house is free and clear so you can buy it. Make sure that if I'm buying a house from Bishop Long, that he really own it for real. Otherwise, they make sure that that's taken care of, and they get that clear so that you can really buy that house, and then they put it in your name. The appraisal of the home, you have to pay for someone to go out to that house and to go inside and to look at it and to see how much it's worth. Then inspection, and some of you have gone through some of these things before, and feel free to chime in. The inspection. Before you can purchase a home, you have to get it inspected, and the inspector is different from the appraiser, because the inspector is looking at the things that the appraiser doesn't see. Appraiser is looking at how it looks from the outside, then they go in and see if you got granite countertops, and it's looking at the cosmetics and those types of things. And Bishop, I'll let you preach this, but the inspector is going to go deeper. The inspector is going to look inside at the foundation. He's going to look at pipes, and he's going to look at things that cosmetics cannot see. So he's going to look at the heart of the matter.
My.
He's going to look at the heart of it. He's going to look at cracks in the foundation. If you remember, not too long ago here over the summer in Miami, the most horrific thing, a building came down. Well, an inspector had gone in and said, hey, it's some cracks in this foundation. Hey, it's some water that's filling up down here that's not supposed to. Hey, this concrete is buckling and it's doing some things. That's what an inspector does for your house. So the difference between your appraiser and inspector, and you have to pay for both of that. And then document prep. Yeah, these are fees that lenders just throw in there to get your money, but doc prep. You've seen that when you've purchased a car, they call it a doc prep fee. It's a fee that you have to pay. And then legal. Some states require that a real estate attorney take a look at your closing documents, take a look at your contract. And these are all things that you have to pay for up front. So I'll say up front, you have to pay for this. These aren't things that you can pay for over time, or things that you can finance. And no, all of these in the closing costs, you have to pay for upfront. And then they look at manageable debt. That's what the debt to income, they're looking at how much debt do you have, and can you afford to buy this house? They verify your employment and income. And then they look at reserves. Here's that reserves word again. They look at, once you get this house, if something happens, can you still pay for it? Do you have 3 months of this mortgage payment that you could still pay for this? They look at that, all of this, and that's a lot when purchasing a home. So we have to make sure that we're looking at all of this before we go to the mortgage company and say, can you pre-approve me for a loan? So we talked about the differences, and here is FHA loan versus conventional. So an FHA loan, the Federal Housing Administration, that is a branch of the government, a branch of the Treasury that loans money to, it's supposed to be for low income clientele, for people who wouldn't get, in the mortgage world, we call it a conventional, which you see here, for people who are low income and credit might not be as strong, but you're still worthy to buy a house. The FHA, what that does is it backs the loan. So the government basically says, okay, Chase Bank, okay, Wells Fargo, if you loan, I'll just use Bishop Long as an example, but I know his stuff is strong. So if you loan Bishop Long $150,000 to get this house and he defaults, we will pay for it. That's what FHA does. They back the loan and they tell the lender they're not as strong, their credit is not as great, but we'll back it. So if they foreclose, we'll pay for it. That's why their criteria for meeting a loan is a lot more strict in terms of making sure all your T's are crossed and I's are dotted. But a minimum credit score to get an FHA backed loan, and FHA, that's not only that also applies to VA loans. So a VA loan would fall under the category of a FHA. And VA loan, meaning if you are a veteran, the government says if you loan Minister Lisa, she's a veteran of this branch of the military. If you loan her this money and she defaults, we'll pay for it. If you loan this person that used to be in the Air Force, used to be in the Coast Guard, money for this house and they default, we'll pay for it. So a VA benefit, VA loan falls under this same category. Your minimum credit score is 580, but you have to have a down payment of about 3.5%. A conventional loan, you see in parentheses, it says private lender. That means any bank, and it's not backed by FHA or VA. That just means the bank is just going to loan it to you based on their lending. Your minimum credit score has to be 620. But let me remind you, the lower your credit score, and I think I put it on one of these other slides, the lower your credit score, the higher or worse your interest rate is going to be. So if you owe a government agency, you have to be current or paid in full before purchasing a home. And I'll tell you why. So if you owe back federal or state taxes, the bank's not going to lend your money. Doesn't have to be paid in full, but definitely has to be current, can't be in default. If you have defaulted student loans, federal student loans, if you have defaulted child support, because that's considered to be the state owing the state, if a government agency, if you owe any of these, or there's a few more that's on this list. If you say you had a racketeering case that you, or some type of case that you're still paying on the court costs on, and you owe, Knox County, or you owe Cook County, or you owe whoever county, that's considered a government agency as well. And that's defaulted. That has to be paid in full or current before you purchase a home. And the reason why is the government, the IRS, the US Treasury, they will put a lien on your house. So no lender will lend you money for a house with any of this outstanding or defaulted, because they already know, even if you have a 780 credit score, even if you have an 850 credit score and you have defaulted student loans, no bank is going to loan the money, because they already know once you close on the house, the IRS is going to put a lien on it to where you can't do anything with it. You can't even sell it or give it to anybody without that first. So no lender is going to do it, because then they would actually end up having to pay that if you default. So these are the things you want to make sure is taken care of on your credit report before you go to buy a house. So let's put some real numbers to it. And at the bottom there, I put for Knoxville and Knox County. Knoxville and Knox County, we pay both city and county taxes. The rate for Knox County is listed there, and the rate for the city is listed. It says assessed value, which is different than appraised value, but I didn't put that calculation on there. But assessed value and appraised value are two different things. So for a $150,000 home, your down payment at about 3.5% would be $5,250 that you would have to bring with you. Your closing costs, $3,000 to $7,500. And so that's anywhere from 2 to 5%. And you won't know how much that is exactly until your title company tells you, who is their title cost. Your bank will tell you, whoever your lender is will tell you how much the appraisal costs and the inspection and all those things, but they range from 2 to 5%. So $3,000 let's take the low end. So the total amount of money you will need to bring with you at closing before they hand you the keys when you sign the paper would be about $8,000, $8,250. It could be more if we go to the top of that closing cost range. But about $8,000 you would have to bring a check for that when you close before they give you the keys. So this is just what you bring at closing. So let's talk about what your monthly is going to look like. This is just the $8,000 that you need to bring at closing. And don't forget, you have to have about 3 months worth of reserves to show that you can pay for the house for a couple months if something happened. So real numbers. So on this same $150,000 mortgage at 4% for 30 years, and you can finance a house for 30 years. That's the most you can do is 30. You can finance a house for 20, you can 25. You can even finance a house for 10. Your monthly principal and interest will be about $691. Property taxes. Remember, we have about city and county, and that's not on. So we don't want to take 150,000 mortgage to calculate. It's on the assessed value, and the assessed value is like 80% of the appraised value. But your property taxes would be about $200 a month. Your homeowner's insurance, about $100 a month is what that would be. That's the range is anywhere from about $800 to $1,200, $103, $100 a month. Your private mortgage insurance, PMI, you may have heard of that before. If your down payment is less than 20%, and so if you're if you're up here and you got the 3.5% that you are doing for your down payment, that means you will have PMI, you will have private mortgage insurance, and that's about $60 a month. So your total cost monthly for this home is just a little bit over $1,050. So this is doable. So if you already pay, say your rent is $800 just for your rent, this is doable. This is not a stretch, because don't forget, you still have your KUB and all of that you pay. So this is not that far off. So according to these numbers for your home purchase, your income should be at least for $150,000 house, for this house, $150,000 at 4% for 30 years. This house that you will need about $8,000 at closing. This house, your income needs to be at least $20 an hour, $830 a week. Now, these are gross numbers. So these are not your take home. This is your before. These are your gross numbers. So about $20 an hour, $830 a week, $3,600 a month, $43,200 annually. This total cost of $1,050 is 30% of this number. So this number, this house, 150,000. So I wanted to put the calculations on there so that you can adjust it to fit what you're thinking. You may want a house that's 100,000. You may want a house that's 250. That's okay. You still can calculate all of that. So for this house, your income needs to be at least $20 an hour. Now, if it's two people that's working and you want to put those income together, you definitely can do that. Plug up my laptop. You definitely can do that. You can put that income together, but together, y'all need to make at least $10 an hour. You need to make at least $830 a week, $3,600 a month, $43,000 annual, but that is doable. Things to remember: the better your credit profile, and when I say credit profile, I mean credit score. This is your credit profile. Credit score, debt to income ratio. This is your credit profile. Manageable debt. The better your credit profile, the lower your interest rate will be. Because 4% is actually kind of high for a mortgage. you could do 3.5, 3.25, but that's not a bad rate. So the better your credit profile, the lower your interest rate. And then the more you put down over that 300 or that 3.5%, the less your monthly payment will be. So you can definitely use these numbers to, if you see yourself, you want to purchase a home within the next 12 months, 24 months. I wanted to give you some real numbers. So if, okay, we got to have 5,000 in a down payment. We got to have 3,000 in this. We got to make sure we have reserves. We have to make sure that we pay off those, you know, whatever that is. This house is doable. Any questions? Any questions?
Right, ladies and gentlemen, the floor is open for questions. Please make sure that you ask any question that you have. This is our, I've been joking with Minister LaShawn about how sometimes revivals carry over. But it's important, if you have questions, that you all go ahead and ask them now, not just about home purchase, but over anything that she has covered over the last couple of weeks. The floor is now open. If you don't want to, again, as a reminder, some of you may have things that are kind of personal and you may not want to publicly say them over the group. What you can do is go into the chat and direct the question to myself or Minister LaShawn, and we will ask the question anonymously. We will share it with the group anonymously. You will not be called out or anything like that, and she will provide the answer. So if anyone has any questions, let's go ahead and get those now.
And if you think about it later and you something that you don't realize right now, please, by all means, you can message me on Facebook. You can message Bishop and he will give me that information, and I'll be happy to research whatever you need and get back to you. Like I said at the beginning, when we started, I really just want to change our mind, and I want to put some of the power back in your hands. I want to make sure that you have all the information that you need, that you will walk into a lender and you already, no, I know what I qualify for. I already know. I've already added this up, added that up. Nope, here's my income. Here's this. Nope, I've already cleaned up this off my credit. So I just want to put some of the power back in your hands. I never want you to walk into sometimes a car dealership and then I'll be back, and they go talk to a bunch of people, and then they come in and give you these offers that have you paying double and triple. I already know what I qualify for. That's cute. I'm not doing that. I just want to put the power back in your hands. Okay, Bishop, that's all I had. Thank you so much.
All right. So if there are no other questions, we'll go ahead and end for tonight. Thank you so much. Now, just so you'll know, before everyone drops off the line, I do want to just remind you that starting next week on next Wednesday, I will be beginning to share the spiritual side of things. We had First Lady Wright opened up and she shared with us things about credit. She shared about credit. Then after she taught her courses on credit, now we have Minister LaShawn teaching on the financial end of things and from the banking side. And now I'm going to come back and close this out with the spiritual side of things as well, because a lot of people have questions. Even she talked about tonight about touching the theological questions of things such as far as your tithe is concerned, when you're paying your tithe, do you pay your tithe off your gross or your net? And the principles of tithing. Is tithing even a mandate by the Spirit of God?
Watch it, Bishop.
Yeah, I'm gonna deal with that. I'm even going to deal with that the concept that we've lived by, we've been taught all of our lives. Many of us that have been in church for any extended period of time, we've heard the concept, will a man rob God? Wherein have you robbed me? In tithing and offering. And thereby you've been cursed with a curse. And so that has been used as a mechanism of fear among God's people. And so we're going to talk more in depth about that starting next Wednesday night. So even our guests, I want to invite you all to come back. We're going to take a look at the biblical approach to finances. We've taken a practical look. Now I'm going to talk about the biblical approach to things so that we can really have a full, the triangle, if you will, the triad, if you will, of how to approach our finances, both naturally as it relates to our credit, our banking, and then spiritually, how do we manage our finances when it comes to the things of God? I do not want, and I'll say this very quickly and I'll close. I don't want the people of God being manipulated any longer when it comes to their finances. I'm over those days. People have revivals and call the lines. Y'all have heard me say this over and over again. They call the lines just so they can count and see how much money is coming in. So when it's time to get their honorarium, they knew how many people were in that line. Yeah, those are the games people play. And y'all don't know that because the agreement in the back is 50% of the offering that comes in goes to the guest preacher. I don't have a problem. I mean, y'all know I'm an itinerant preacher, so I don't have a problem with the idea of probably blessing the man or woman of God. The problem I have is when they use it as a game and manipulation of the people of God. Okay, so that's an important truth. So we're going to be talking about a lot, not just that, but it's going to be a lot more that we're going to address in the next session on Wednesday night. So we want our guests, all of our guests, thank you so much for being with us tonight. Kingdom Life, thank you guys for being there. And we will see you all on Sunday. Love you.